oftentimes what is confused in a mortgage transaction is who is what party in the agreement, right? So usually in a standard conveyance, you have the vendor and the purchaser, or in a gift, you have the donor and the donee, and usually the person with the E is the person receiving. It's the opposite in a mortgage, right? The mortgagor is actually the individual who would have originally owned the property, and the mortgagee is the person who the property is now being handed over to be mortgaged. So what do we mean by that? Most frequently in mortgage transactions, a lot of times it happens with banks or financial institutions, and a private party. And the private party who would have been the original owner, they become the mortgagor, and the bank and institution is the mortgagee. And in exchange for a fixed amount, you are exchanging your property or letting it be held by the mortgagee for a specific period of time and in a specific manner.
Thank you for that. So, and one of the things, again, just for those of you who are new here, feel free to ask questions at any point in time. We will be answering. We create a dialogue here on this webinar so that we tailor the webinar for those of us who are here, right? Not just because the topic is the topic, but it surrounds the topic, right? Now, in terms of this mortgage contract, as we spoke about, that happens between a financial institution and an individual. What are some of the other contracts that lead up to this, especially within the real estate space? I don't know if Pierre, you want to take that question.
Right. So you would have, of course, offer and acceptance for a property. But one of the main things as a real estate agent, sometimes we see clients missing, is that they go house hunting or looking for a home without being pre-qualified, right? So that's the first step. You know, anytime you're thinking about getting a home, the best thing to do is be pre-qualified, because chances are you're using a financial institution to purchase. So you need to understand what you can afford when buying a home, what your income would allow you to purchase. So that I would say is the first step in the process for any would-be homeowner. You know, get pre-qualified. Usually where your income goes, you know, where your salary goes, that would probably be the best place to go. And oftentimes it's better to do it as soon as possible, because with each passing year, your mortgage installment would go up, right? So as soon as possible, if that thought enters your mind. Then you would then go looking for homes. You know, you'd probably contact a realtor. Most persons Google it or Facebook, or you would start looking for a home within your budget. Once you've come across something that catches your eye and you're interested in, you'd set up a viewing. And once you're serious, you should have at least about 10% for down payment, which would enter you into a sale agreement, right? So the sale agreement is that document that precludes the purchase and the closing, so that it spells out how the transaction basically would proceed, right? Your down payment and the terms of engagement. And then, of course, would come probably 90 days later, roughly 3 months. That time can be negotiated with vendor and purchaser. You would have the closing agreement, which would be the formal deed of mortgage. So that sort of is the process, or the documents which are involved in the process.
In my tenure here, and we have seen a lot of different types of deeds and types of mortgage contracts, and so there are the ones that may have stipulations and criteria can you explain what and how these things are enacted? What you could find in some of these things, and how are they enacted, or how are they enforced?
Yes, good. So one of the most common problems I've seen persons who have a mortgage out with a financial institution, one of the difficulties they have understanding is what an actual what sort of situation a mortgage creates if you have one. Understand that a mortgage is you transferring your interest as a security in exchange for a loan or another obligation. And so when you have transferred that interest that you have, you no longer have it. You cannot go and try to do something else with that mortgaged property in the meantime, so as to sell it or sell a piece of it, or rent, create a lease. You are no longer the owner. And that's one sort of condition that needs to be properly understood, because I have seen time and time again persons knowing fully well that they have a mortgage on a property, entering into sales agreement to sell without upfront disclosing that mortgage, right? You are no longer really the owner. The institution owns the property. So that's one. Why is that? Well, if you look into your mortgage deed, your deed of mortgage, which is essentially an agreement, you will expressly see that, right? As well as the obligations that you create for yourself as the mortgager under the mortgage. The institution did not give you this money just by chance. And they are holding your property as security. Now, what is something that is very common, and I think this is what trips people up, is that you can transfer your mortgage. So you could transfer your mortgage from one bank to the other. You could transfer your mortgage to a purchaser, right? Somebody can purchase your property and take the mortgage or take over the mortgage for you. However, that is a lien or an encumbrance, really. It is not that you as an owner, it's really you asking the bank for somebody else to continue with this obligation on your behalf. And I'm trying to explain this as simply as possible so that people don't get confused with it. But it is something to legally always understand. When you take out a mortgage, you've given your property to be held by the mortgagee, right? And you cannot transfer interest but yet retain it, even though you're living in the house, even though you're paying. And somebody says, I pay in my mortgage, it's my house. I understand the feeling of that, but you are governed by oftentimes mortgages are very, very long. They're very wee documents. We who research title, it's a mortgage just by the amount of pages there are that constitutes the deed. Very popular mortgages are, of course, HDC mortgages. Many persons are on HDC mortgages and they do not read. All right. After that mortgage, and there's often requirements as to how to sell that property that is mortgage. That usually includes getting permission or consent from the mortgagee. You can't just be doing what you want with your property anymore without including the financial institution. And then, of course, there are private mortgages. So if Mr. Paul, you and you see, a mortgage contract is created to establish a borrower-lender relationship between two parties, right? I would like to borrow something you would like to lend what is the power of seal granted to the mortgagee, how they're going to exercise that power in the event that you have defaulted on payments, etc. So these are very important things that should be considered when understanding mortgages, and that should be understood clearly by the mortgagor, which is the private person.